Rarely will anything force homeownership more so than new babies.
Yeah.
We love them. We love them. But those diapers all of a sudden mean it's time to get out of the city and it's time to get out to the burbs. But purchasing real estate isn't necessarily the easiest to navigate, especially if you don't know what you're doing, you haven't done it before, or you don't have a good team in your corner. We're going to talk mortgage to you today. We're going to strip down exactly how this newlywed couple with the new baby was able to leave the big city, head out to the burbs, and purchase their first home when they never felt like homeownership was going to be attainable because they didn't have enough money for down payment and closing costs. And with me today is my main man, David Hochberg, Team Hochberg. If you're in Chicago, you hear him on the radio every Saturday, WGN, but he's with us to share real life stories of families that his team is helping day in, day out through their mortgage operation. So Hoch, what you got for us today?
I'm going to paint you this scenario.
Okay.
1,000 square foot, 2-bedroom apartment in the city of Chicago. 2 kids, a dog, growing, popping out of the place. They're going crazy, right? You got the kids running around, you got toys everywhere, you got the dogs, they've got to get out. Parents are out in the burbs. Their jobs are out in the burbs. So they want to move out of the city to be closer to work and be closer to daycare. So they found this place, great income, I think combined around 200 grand a year. They're going to have a couple of grand to move all their stuff. They're renting downtown. Found this great $700,000 home out in the western burbs.
Because you're talking about Alan and Casey, right? Alan's probably 32, Casey's like 29 years
exactly.
old.
Exactly. Alan and Casey, 32, 29, 2 kids, right? Now the kids are getting bigger. They're running out of more room. They've got everything, diapers and butt cream and ass wipes. I mean, right? Butt wipes. You know, if anybody's had kids, you know what I'm talking about. They're screaming, they're crying. You're about ready to lose your mind. So they found a place. Great. They have all of these expenses from giving birth and having nannies and all this stuff. So down payment was tight, and closing costs were going to be close to $8,000 to $9,000.
Ooh, so you're talking about a $21,000 down payment plus an additional
3% down.
Yep, so 3% on like a $700,000 house. Yep, last time I did that math, it's 21 grand.
21 grand.
Plus an extra $12,000 to $15,000 in closing costs.
Well, closing costs, you got to buy the insurance, you got the attorney. So all in.
Property taxes,
tax,
home appraisals, all that. Yep.
So they didn't have the money. So I'm like, okay. They're like, and they started getting, low that. I said, tell you what, there's something called premium pricing. They're like, what's that? I'm like, okay, I opened up my pricing. Right?
Yep.
My optimal blue.
Yep, because as a lender, we get to look at pricing. It looks foreign to someone who doesn't do what we do for a living.
It's like a Chinese menu in Chinese.
Yes.
Until you open it up, you're like, okay, here's where you would be right here at par, right? Where you'd get close to zero as we can. Let's say it was 7 1/8.
Yep, so in layperson's terms, if I offered you 7.125 as your interest rate, please know you're going to have to pay my underwriting fee, the appraiser's fee, the title company's fee, the state's fee, the county's fee, homeowners insurance, real estate taxes, and if they're moving out in the suburbs and it's in a homeowners association, there's a good chance the HOA has their own fee.
Sure.
Or if you don't want to,
or you don't have the money to,
what can they do?
So I showed them, okay, here's 7 1/8. I don't have any extra premium on this, which means the investor that we're sending the loan to is not paying any extra. I go, but if we increase your rate, in this case, I believe it was like 7.75, 5/8 of a point.
So they're going from 7.125 to 7.75%.
Right. Yes, their payment's going up.
Yes.
On a monthly basis, but it generated an extra $15,000 in premium, which we then took that $15,000 in premium and gave it back to them in a closing cost credit.
So in their mind, they're thinking, I need 21 grand for my down payment. I need 15 grand for my closing costs. Last time I did that math, it's $36,000. I ain't got it.
Correct.
Right? So they're, woe is me. I'm never going to be able to buy a house. This sucks. I guess I'm stuck living in this 1,000 square foot apartment in the city.
Right?
I'm not going to move to the burbs until you guys were like, no, let's help you find a way to yes.
Right.
Okay.
So we just showed them, hey, if we go up in rate, it's going to cost you, it was a little over $300 a month, okay? So you're going to be paying an extra $300 a month, but you're going to get a $15,000 closing cost credit that's going to enable you to purchase and acquire this home. Closer to work, more room, better schools, closer to your parents, free daycare, which is going to save them $1,500 a month in daycare. Okay?
$500 a month paying down their mortgage.
Paying down, right.
If homes appreciate at 2 to 3% annually, which
14 G's a year.
Over the past almost 100 years, it's been well above that on average. But yeah, there's another $14,000 to $21,000 in equity you're going up for an extra $300 a month.
In this scenario, okay, so what do? They have to make at least 6-7 payments, or else we get tagged with an early payoff. If rates are lower in 7 or 8 months down the road, we'll take a look to refinance them, cover all their closing costs at that time, and try to slide them down into rate in order to save more money. Maybe we get a little bump in value because as the rates come down without inventory, because it took them 6 months to find this place. As the rates come down, more people will get in the playing field, to get off the couches and out of their parents' basement and try to buy a home because they could qualify now. It'll push prices up. You'll pick up equity there. Maybe we go from 3%, 97% LTV, loan to value. Maybe we pick up some equity, get to 95. I had some cases within a year, we went from 90 to 75.
Wow.
And got a PIW, a property inspection waiver. Super lucky in a condo, so it helped out those borrowers tremendously.
So what you're saying, if I'm picking up what you're putting down, this $300 a month wasn't for 30 years.
No.
It wasn't even for 3 years.
No.
If everything goes according to plan, it's somewhere between 6 to 16 months of them paying the extra $300 a month. But what they got in return was A, they got to buy the house.
Correct.
B, they got to become a homeowner and reap all the benefits of homeownership. But C, they got the $15,000
worth of value instantaneously, and we're able to close on that home and not deplete their entire savings account or take out a 401k or go to family members and ask for a gift.
Yeah.
So we got from no and the borrowers freaking out, trying to overcome a challenge, that we overcome these challenges every day.
Yeah.
Okay, we see them every day. So they're like, well, they don't have $15,000. Where am I going to come up with the closing costs? I'm like, all right, let's switch to decaf. Let's pop an Ambien. Let's relax. Let me show you what's called premium pricing. It's a strategy I've been using for 25 years that mortgage professionals that are experienced use every single day.
Yeah.
That's how we cover the closing costs on refinances. Yeah, you might not get down to the lowest, but we're not charging you $2,000, $3,000 in closing costs. We're bringing you down, giving you a closing cost credit. You're still saving money. So we could do that on a purchase as well. The key to the story was, if you work with trained professionals that are experienced and know how to play the game, there are solutions to overcome challenges that you might not even know are available, that we see and overcome every single day of every single week that we're in the business.
Well, I think it's just a gentle reminder that there's no such thing as a one-size-fits-all mortgage.
100%.
I think that's where the media truly screws it up for middle America, is making us all believe that, well, there's one mortgage rate, there's one loan program, and it's like, no, there's hundreds of loan programs. And there's never one rate. There's always the best loan structure for you. What your team did for this young couple with the new baby, with the expanded, because this is what happened, right? They're having more kids.
Hopefully,
that's where
God willing,
Well, that's where they are in life. Well, they had more kids. The kids are in diapers. It's time to get out of the apartment and time to move out in the suburbs. Yet they were struggling, not being able to come up with all of the money that they're going to need for down payment and closing costs. And you're like, well, wait a minute.
Creative financing.
Yes, let me get creative. Let me tailor make or structure the right debt, the right loan, so I can show you how you can become a homeowner. So this was for Alan and Casey. But for the people that are watching this right now on YouTube, you could be Alan or Casey, or your kids are Alan and Casey, or maybe it's your coworker, it's your next door neighbor. Whoever it is, please know you're not alone. Like, there are experts like the Hochberg team that are ready to help. And if you would like a free consultation with David Hochberg, you have that ability. All you have to do is click the link below in the description. It's going to take you to a new webpage. You're going to fill out a quick questionnaire. That questionnaire will then get emailed to David. David will then get you on his calendar so he can walk you through your scenario and help tailor make the right financial solution for you, whatever that scenario may be. And who knows, you may be the next Alan and Casey.
Can I just say one thing?
Yeah.
You might not be ready to purchase today. We do a lot of forecasting. So you come to us today, which you've got a plan to buy in the future. You might be credit challenged, right? You might be thinking of starting a family. You don't know how to budget. That's what we do, right? If you're credit challenged or don't have credit, we'll help you establish credit. We'll help you strengthen your credit. And it's the long game, right? It's not one and done and we throw you into the waste paper bed. No, it's if you've got a plan, you might not be ready to buy today, but if you want to buy in the future, we'll set up a roadmap there. I know people don't know what roadmaps are because everybody's on Waze and Google Maps, but we'll create a plan in order for you to get from point A to point B in however many months that you want to do it. So I just want to throw that out there.
Yeah, no, it might not be a roadmap for these ladies and gentlemen. It may be a playbook.
Yeah,
right?
That's better.
You're going to have a personalized playbook.
That's better.
Because everyone should get to hear the words yes.
Yeah.
But it's, for some, yes and now. Others, it's yes and here's how. And we put together that playbook. So, Dave, thank you again for your time. Thank you for your stories.
Yeah, thanks.
And again, click the link if you want a free consultation with Hoch.